We'll now look at comparison of different type of CDO, starting with cash flow CDO versus market value CDO. So the primary difference between cash flow CDO and market value CDO is the source of cash that is used to satisfy investor claims. Cash flow CDOs satisfy the principal and interest obligation to the investor from the associated cash flow, which are the scheduled principal and the interest payments on the collateral pool. On the other hand, market value CDO periodically sell securities from collateral pool to manage the promised investor claims. Market value CDOs are rapidly disappearing from the segment, and they're not much seen these days. Then we move to the static versus managed CDO. Static CDO essentially describes as balance sheet CDO. The collateral assets are purchased, placed in the collateral and distributed based on cash flow of the underlying asset. No active management is needed in the static CDO, as the name suggests. Whereas the managed CDO involves varying degree of active management if the CDO is lightly managed. The collateral manager will selectively and preemptively sell assets. On contrast, a static CDO, the manager cannot sell assets even if the anticipation of ever an adverse credit event. Finally, actively managed CDOs involve fully blown asset management. The collateral manager has the authority to sell, purchase, manage pools to maximize investor return. Both static and actively managed CDO have a ramp up period where the collateral manager selects and assembles the assets. So naturally, the larger and the more complex portfolio will require long ramp-up periods. After asset location, the active manager must make reinvestment decision. Typically, the manager will purchase new assets from a pool rather than pay down current note holders. So finally, the degree of active management may affect legal and accounting aspects of the CDO. For example, if the collateral pool is classified as a qualified SPE, it can avoid the FIN 46R, which is the anti-enroll rule. So additionally, the capital structure of the arbitrage CDO becomes more complex because of the performance-based management fees, and the fee may be subordinated claim or partial interest in the residual equity tranche. So synthetic CDO, we move to a new topic here. So under the collateral debt obligation, the originator or the collateral sell assets to the SPE for cash. A synthetic CDO, or the short form used is SCDO, creates the same economic exposure as the cash CDO but without a legal sale of assets. Rather, the credit exposure arises from selling of credit protection, that is credit default swap. The premium from the default swap and the fund from the sale of tranches are used to buy high quality assets. So in a synthetic CDO, the SPE would get the swap premium from the issuer, and it will pay the issuer the payment only in case a default occurs, and then the SPE uses that swap premium that it's getting to buy high quality asset and create tranches and sell it to the investor. The benefit of the SPV in the synthetic CDO is that the assets are not legally transferred, so they don't appear on the balance sheet. The SPE also does not have operational risk with respect to original assets. In a cash CDO, it may be unfeasible for political or legal reason for the SPV to press for payments from the security issuer. The synthetic CDO will be liable for economic loss on defaults within the collateral pool from the obligation as protection seller. At this stage, we note an important difference between traditional CDO structure and synthetic CDO. Under the former, the CDO is pre-funded by actual assets that are transferred to the pool. For the latter structure, the investor faces potentially credit risk if the funds to cover default are still housed with the originator. Fully and partially funded CDOs. So when the securities are issued to investor and fund allocated are sufficient to cover all future defaults on a portfolio, they are considered as fully funded. We have previously discussed one fully funded security in our earlier videos, which was the credit linked notes. So the investor in that structure is also the protection seller and receive enhanced coupon. But in case of a default, the protection seller, the investor has already deposited the par value of the security and maintains the long position of the actual note. This effectively describes physical settlement of CDS. For a synthetic CDO, the fully funded status signifies that the cash raised from the investor is enough to cover the maximum payout of all the credit protection sold via SCDO. So as was the case for the CDOs, the structural differences between balance sheet and arbitrage CDO carry over to the synthetic counterparts. So for a fully funded balance sheet CDO, a reference portfolio is identified as the originator. Notes will be issued by the SP for the exact size of the reference portfolio. The proceeds from the sale are held by the trustee who purchase high quality assets. In turn, these securities are pledged as collateral to the originator to back credit protection sold. Just as the arbitrage CDO has important differences with balance sheet CDO, the same holds for synthetic counterparts. The SCDO, the arbitrage SCDO, uses collateral manager to select the reference collateral pool. The SP creates the credit exposure by selling the CDS, which effectively synthetically securitizes the collateral pool. As with the arbitrage CDO, the collateral manager may lightly or actively manage the pool, thereby selling or hedging the cash flows. Similarly, the equity tranche may be sold to investor or held by the collateral manager. The key point here is that there should be no moral hazard problem associated with the balance sheet CDO. So it is typically very costly to fully fund the CDO. Rather, the convention is only to partially fund the portfolio, where the remainder is retained or serves as the reference for an unfunded credit risk transfer. Intuitively, securities are issued for less than the face value of the collateral pool, hence only part pool is backed by real asset is the case of default. So there is something called the super senior tranche, which is placed at the top of the capital structure. Even though there is no capital backing the security, the super senior tranche will still be considered by AAA because of extensive subordination, that is creating tranches of different priority levels. Now we move on to the regulatory consideration. The details of the regulatory capital consideration is quite complex, but we'll only look at some of the basic things here. So let's consider a fully funded SCO. The regulatory capital charge is equal to 100% of the residual tranche retained by the originator plus a risk adjusted charge for the actual swap. So for example, the CDS is backed by treasuries. The capital charge is 0% according to the Basel norms. At the time of origin, we see that in the allocation. So a 20% capital allocation charge will be levied if the underlying collateral debt is issued by an organization for economic cooperation and development bank. So as we'll see that in Basel norms, we'll look at how to give risk weighting to all of them. So the risk weighting relative to the base case is 8% of the capital. So there are some benefits of the CDO. We'll look at 5 of them. So synthetic CDO avoid the associated legal risk of the loan sale, particularly if multiple taxation authorities are involved and there are complicated covenants. Syndicated loans may have resales restriction that reduces the economic incentive to securitize. The SCDO structure provides tremendously flexibility to the structuring agent relative to a balance sheet CDO. The ISDA documentation is much simpler than the loan documentation. Banks are able to create specific payoff, deductible, deduce, and it to default or any other specific feature. The advances in the CDS documentation has helped facilitate the rapid growth of market. Some proponent feels that there would be a disappearance of the traditional CDOs altogether. The synthetic structure allows banks and investors to isolate credit risk from interest rate risk, political risk, and other risk factor. The super senior tranche allow financing at rates even better than the AAA rates. So those were some of the benefits of the CDO. Now we move to the second generation synthetic CDO, or which has got something called the CDO square. So the birth of single tranche synthetic CDO fundamentally changed this market, and the investor delineates the terms and exposure they seek. The desired exposure is typically the mezzanine debt, referencing a basket of single name CDS. So unlike the previous synthetic structure, the originator will issue only a single class claim against the synthetic pool, and this has a number of implications. First, that the structuring agent will retain the exposure from the pool remainder, either actively hedging the credit risk or placing the issuer at a later date. So synthetic restructurization is simply a CDO of other CDO tranches issued as a new security. So this is a general term, as the CDO tranches may originate from an ABS, residential MBS or commercial MBS. So we can see that the CDO square is a special case of resecuritization which is reconstituted from tranches of CDO. In effect, the CDO square is a CDO of a CDO. The process of constructing the CDO square is the same way as we saw for simple structure. CDO structure is also a repository for segments of other arbitrage CDOs, particularly equity tranches, which are not placed with the investor. Hence, unsold and unattractive tranches are now being packed and sold to the investors after resecuritization. So that was about the second generation CDO. Okay, let's start with cash collateralized debt obligation. This topic in the exam talks about different types of CDOs, the motivation behind making them, and their structure. So CDOs are generic structure where investors are promised principal and interest backed by a pool of debt instruments, and they could be backed by bonds, loans, or with both. The motivation here may be either credit management, which is known as the balance sheet CDO, or investment management, which is known as the arbitrage CDO. Market value CDO differs from the cash flow CDO by selling the asset from the collateral pool to satisfy investor obligation. Now some CDOs are static, which means they are passive investment, where others are actively managed, which means they are light or full-blown active management. For example, the difference between the balance sheet and arbitrage CDO and the other types of CDO is a type of question that you can get in the exam. So let's start with what the CDO mean. CDO is a general term for asset-backed securities that issue. They are issued and they pay an interest part and a principal part from a collateralized pool of debt instruments. The generic name CDO implies that the underlying collateral is comprised of collection of debt and loan. A convenient way to describe CDO is by the underlying collateral or economic purpose, for example a balance sheet CDO or an arbitrage CDO. If the underlying collateral pool consists entirely of bond, then the issue is referred to as collateralized bond obligation, whereas if it's made up of loan, we'll refer it as a collateralized loan obligation. Now, creation of a CDO. In order to create a CDO, the issuer packages a series of debt instruments and split the package into several classes of securities called tranches. Each tranche has a different claim on the collateral pool cash flows and different exposure to the default risk of the asset in the pool. The largest part of the CDO is typically the senior tranche, which usually consists of AA or AAA credit ratings. So regardless of the quality of the underlying asset in the pool will have the senior tranche, which would be a AA or a AAA credit rated tranche. The senior tranche is accompanied by a series of mezzanine tranches and finally an equity tranche. The equity tranche is commonly referred to as first loss tranche because it is the first to absorb any losses from the debt securities in the pool, making it the riskiest part of the CDO structure. Subsequently, losses are absorbed by the mezzanine tranches, making the senior tranche the last in line to experience the loss. So there has been a lot of growth in the CDO, and we can attribute that growth to 4 parameters. One is that the CDO gives investor access to a diversified pool of risky assets. So risky credit assets have low correlation with S&P and US Treasury bond. As a result, these assets provide excellent potential for diversifying a traditional stock and a bond portfolio. Credit ranging allows investor to select his specific credit rating exposure, which is part 2. So they offer the specific credit risk that each investor want. The third reason for the growth is that CDOs gives banks an efficient way to manage their credit risk, because bank can use CDOs to transfer risky credit assets off their balance sheet and thus freeing up regulatory capital and reducing risk exposure. Now fees are collected by asset manager and underwriter And asset managers collect asset management fee for managing the CDO structure, while brokerage firms collect underwriting fees for selling the CDO tranches to client. So the combine of investor demand and profit for supplying CDO is a powerful incentive which has created a lot of growth in the CDO market. So in this topic we are going to compare various types of CDOs and understand how they work. To start with, we are looking at balance sheet CDO and arbitrage CDO. So balance sheet CDO is motivated by the asset owner wishing to remove the selected assets from his balance sheet. Potential motivation include credit risk managers, liquidity, raising capital, and debt management. Consider a bank that sells a part of its loan portfolio, thereby replacing long-term asset with short duration assets, which is cash. So on the other hand, investors constantly demand new and innovative securities with enhanced yield and specific risk return profiles to fit their investment criteria. This gave demand to arbitrage CDO. So the reason why arbitrage CDO came into existence is because they are innovative securities which has enhanced yield and a specific risk return profile that an investor can select from. Specifically, arbitrage CDOs are financially engineered products designed to profit on the spread between assets in the pool and promised payment to the security holders. The clear difference in motivation between balance sheet CDO and the arbitrage CDO leads to important distinction in the management and structure of the asset pool. The arbitrage CDO implies active management and employ a separate collateral manager. The balance sheet CDO is much simpler. The originator selects the assets for conveyance and remains hands-off. The originator may seek the help of a structuring agent or advisor, but the role is much more limited than collateral manager of an arbitrage CDO. So the fundamental nature of balance sheet CDO dictates the asset structure because the originator is very likely to be a bank and the target assets are typically loans. Therefore, a specific pool will be considered as a CLO. So a type of balance sheet CDO is a CLO, while the size and composition will be varying from pool to pool, and CDO can contain an asset in excess of 1 billion formed from many loan or syndicated loan participants. Under this structure, it is natural for investors to have concerns about quality and performance of the pool. So to provide assurance to the investor, the originator may include credit enhancement such as cash collateralized account. The cash collateralized account accumulates a portion of excess spread, typically 50 bps, to fund potential shortfall in the promised payment. The originator will also retain the residual interest, that is the first piece of loss distribution, reducing the worry that the loans selected from the inclusion are substandard. The driving force behind the arbitrage CDO is financial engineering of collateral cash flows, which leads to a very different structure than the balance sheet CDO. First, the collateral will acquire the underlying asset from open market as opposed to a balance sheet CDO, hence the structure is more likely to be weighted with bonds. The role of collateral manager is to actively purchase, reinvest, divest and hedge the cash flow of the pool. Once asset is purchased, they will be sold to a special purpose entity for cash, which ultimately comes from the investor. The assets are held in trust of the investor and backed by the securities, and the credit enhancement are issued by the SPE. So another distinction between balance sheet and arbitrage CDO is the residual interest. The balance sheet CDO endangers a moral hazard problem by self-selecting the assets for collateral pool. Therefore, the originator will include features like CC and retain the residual interest. In contrast, residual interest in the arbitrage CDO may be sold to investor. So the way in which we can differentiate these two would be based on the underlying assets. So balance sheet CDO underlying assets are loan, whereas in arbitrage is bond. The asset origination, the management. So you have to remember that arbitrage CDO may be having active management. The purpose of arbitrage CDO is profit, whereas the purpose of balance sheet CDO is to just manage the credit risk. And the residual interest is retained by the balance sheet CDO, whereas it is sold to the investor by arbitrage CDO. So the benefits and motivation of both CDOs, balance sheet and arbitrage, are different. It is noted that balance sheet CDO is essentially a sale of self-selected assets, so bank can select the loan and sell them. Hence the firm may seek to monetize the asset for cash, maintaining debt capacity, or reduce the size of the balance sheet. So this might be one reason for selling off those loan, which is a balance sheet CDO. Other reasons include isolating asset to reduce adverse selection cost of self-selected loans and increasing transparency. Similarly, the firm can experience a slight benefit by reducing asset under management and controlling and avoiding poor and virtually decreasing investment. Finally, credit risk management via balance sheet CDO has the potential to free up capital under Basel II norms. The motivation behind arbitrage CDO overlaps substantially with balance sheet CDO. The issue are constructed while the sole purpose of providing new investment opportunities by altering cash flow and creating new investment vehicles. The collateral manager simultaneously seek to maximize the fund gap between the collateral pool and the weighted average cash flow due to investor.